Hey, welcome everyone. Tom here from Park Avenue Trading, your chief dealer, keeping you sane in insane markets, and also trying to offer you some good trading technique that you can advance your trading with. And I'm here to discuss Fibonacci because it seems to be extremely popular, and I can understand that. But everything that's out there has been, I've taken some notes here, so I'm going to be reading some of my notes because I've become quite frustrated with the information that's out there, even in books. There's a lot of books on Fibonacci trading that really are just nothing but repeats of the same thing over and over again without any true usable techniques. So in this video that we're going to be doing, I'm going to be giving you some usable techniques and something that there's some action steps that you can take so you can start to understand how this principle of Fibonacci ratios works. And nothing is infallible. That's the most, and in all the books, they're going to be talking about price clusters and all this stuff without any real genesis of where we start. And like I said, everything out there is pretty much of a huge disappointment. The vast bulk of the stuff out there is just repetitive, fairly uninformative examples, and very small part of anything that's useful for you. So what we have to understand about Fibonacci ratios, aside from the number sequence. Now I'm hoping that you know the number sequence. If you haven't, it's 0, 1, 1, 2, 3, 5, 8, and you keep adding the succeeding number by the previous number to keep going forward. Now, eventually, after a certain amount of, say, 10 or 8 to 12, 8 iterations, when you divide the succeeding number by the preceding number, you're going to come up with the golden mean, which is 0.618. Now, 0.382 is actually 0.618 multiplied by 0.618 gives you 0.382, or it's 1 minus 0.618 gives you 0.382. So this is like the mathematical mystery of Fibonacci. But you have to understand that the Fibonacci ratios became very popular in the late 1960s, 70s, and into the 80s. They became extremely popular. And then there was a rebirth of Elliott wave theory in the 1980s. Now, the reason that people went straight to the ratios was because R.N. Elliott wrote an article basically talking about what became known as Elliott wave theory in the 1950s. I think it was Financial World magazine. I actually went to the New York Library to try to find the article and read it myself, which I did. Unfortunately, I remember bits and pieces of the article. There was nothing really super informative. It was just basically that the marketplace moved in waves. Now, he was basing it off a Dow theory, which really didn't. It got called Dow theory in his time when Dow was doing it. It really wasn't called Dow theory. It was just called like market technique. And it was actually. It's actually useless information, but there was a guy by the name of Rawbacker or something who actually, moved the theory forward in the 1930s. He died really, really young. But anyway, the whole theory was based off of market structure, which is extremely important. And I put out a video on wave structure, Fibonacci wave structure, which is very important. So, not many people view it because I guess they're looking for like the easy way to do this, but it is very simple. And I'm going to show you how simple it can be. Now, a lot of books talk about price clusters, whereas they're measuring one leg against another leg, and then they'll go from low to high, to low to higher high, and they measure and they're looking for retracements that enter clusters. Now, sounds great in theory, but if a marketplace is truly in, a bearish tone, it's going to switch. It could be bullish at one point and then switch to bearish. So you need specific like ideas on, like, if you're going to trade short term with using Fibonacci ratios, you need to have some hard and fast rules. I'm going to be offering you a tool that you can use. It's called Trend Degrees. And unfortunately, sometimes the cache gets all jammed up because a lot of people use it. I haven't figured out like if there's some type of plugin I can put on inside that programs to clear it automatically. Right now, because so many people use it, it gets jammed up and it doesn't always work. So if you're one of the fortunate few that get to use it before it jams up, before I clear the cache, just consider yourself fortunate. But the whole idea is actually looking for terminations of, like, if we're in an upward moving marketplace, we're using Fibonacci retracements to basically figure out where the market should stop and at what point it should be going up. Now, a lot of people use the Fibonacci levels themselves, but what I'm going to be introducing you to is something that I call trend degrees. And within the trend degrees, you're going to be able to see, you're going to actually have, I'm going to go over the technique because I already went over the technique, but I'll go over it again. And then in a future video, we'll take it one step at a time. We'll go measuring a leg, looking for retracement point, using trend degrees to find that retracement point, and then using the trigger of the trend degree, and then having the stop loss for the trade, and then the price extensions up. Aside from Fibonacci extensions, we're going to be using trend degrees. Now, what are trend degrees? Trend degrees were based off of a bell curve. Okay, so when we were doing proprietary trading systems, we were quite interested in how far a marketplace would move from the mean and then kind of snap back towards the mean. Sometimes it would swing beyond the mean and then come back, because that's market iteration back and forth. Now, there was ratios that were used and a technique that was used to basically give us a pretty good accuracy. Not a perfect accuracy. There's none. Okay, but it's a pretty good accuracy to determine if a marketplace moved certain standard deviation away from the mean, the snapback would occur. And now we could use a Fibonacci ratio for that, but we could use a trend degree to confirm it. And that's exactly the tool that I'm going to introduce you to. I think it's a really cool tool. And let's get into the video. All right, everyone, let's get into some chart work, the fun part of this whole thing. Okay, so the first thing that we're going to do is we're going to set the chart up like it should be set up. Okay, so what do I mean by that? I mean that you need to follow the Fibonacci principles that I talked about in a previous video. Now, if we're looking at this market itself, right, and we're saying basically, well, we had a downward movement. Now we're starting to get like an upward movement, but then we have another low, and then we have a low, a retracement, and then a lower low. That is the critical price, right? If we're looking at market structure, that's the critical price. If that price breaks, market structure is saying that we're going to potentially surpass this low down here, okay? But it didn't do that. Now we started to rally, and we want to know what the retracement is, right? So what we do is, because we have this new high, we don't know if this is going to be the ultimate high at the point. We have no idea, but what we're trying to find is a continuation of the wave of the movement up. This is where that wave video comes in handy. 13 bar low, 8 bar high, all that type of stuff, because you can actually start to apply that here, and it works out pretty well. Helps, it basically, all we're doing here is we're trying to give ourselves a good indication of the direction of the marketplace, like where it should retrace to, and how far, if it does retrace and breaks, at what point should we look to buy it, where would be the stop loss, and where would be the basic extension to take profits at or to let a trade run. It all depends on, what your trading philosophy is. But the first thing that we have to look at is when we have this high that's made in the marketplace right there. We're going to the left to the last time the marketplace traded higher. So I come over here and I find that point there is traded higher. So I found a new high. Okay, I go to the left. Last time it's traded higher, it is right here. What is the lowest point between this and this? It's this one. So I'm going to draw my Fibonacci retracement levels from this high to this low. So I'm going to take the difference between this high and this low and multiply that by 0.382, 0.618, I use 0.82. I don't use 0.786. 0.786 is the square root of 0.618. Square roots and prices that are square or ratios that are squared have relationships to one another. Hint, hint, hint. Okay? It's important. Gann wasn't the only one that talked about this. Bernard Baruch talked about it. There are a lot of old-time traders that talked about the square root of price being important, or the square roots of things, ratios being important, okay? Gann said that the square root of price equaled time. I have found no ability to do anything with that. Now, if we're using a Fibonacci time series, sometimes it works, sometimes it doesn't. It's nebulous at best. It's basically all the shit that you read out there with Fibonacci books, price clusters and all this type of stuff was of no real use to me. Now, you may find use in it. I have not been able to find any use in it. But all right, so we found this high. We go to the left. We find the lowest price in between. We draw Fibonacci ratios. 0.618 is a significant retracement point. It's one that I like to use. You could use 0.382 if you wanted to. It's not as good. I like a deeper retracement in order to work with. Okay, because that's good. That means that the deeper a market goes, the better, because that means a lot of people are trapped. So when the market paradox occurs, it's going to swing the other way pretty strongly. So what is the market paradox? In case you're not familiar with it, markets are driven lower by strong hands to create better buying opportunities for themselves. They're driven higher. Markets are driven higher by strong hands to create better selling opportunities for themselves. So in other words, the institutional players basically at times can drive marketplaces higher in order for them to sell to us suckers buying. They also drive prices lower to freak the weak hands out in order to selling to them. So we're trying to find those points. We're trying to find the market paradox points. Okay, so when we have this ratio, we have the scale, the Fibonacci scale up. 0.50 is not a Fibonacci number. It's not. It is a retracement. It's a half-point retracement point that got adopted into Fibonacci because back in the old times, in the 1900s, a 50% retracement was a very powerful retracement for a stock or commodity at the time. It's kind of lost a lot of its luster. It's not as powerful as it was. It's on my ratio. It's just there for historical reasons. I really don't even pay attention to it. I should actually wipe it off because I'm really not interested in a 50-point retracement. It doesn't work anymore. A lot of people say market comes down 50%, buy it. Crazy. Why? If it breaks 50, it's going 100% down, right? Or back to the origin. It's lost a lot of its validity. So aside from that, so we found this retracement level. What I'm going to introduce you to is a trend recalculator. Okay, Well, what I want to do is I want to take the high of this bar. Okay, that's the high I think is the high. I'm not sure. I don't know what happened in the future. So this is got to pretend like, I could wipe out that so we don't see it, but for all intents and purposes, it's same shit. You know what I mean? It's a dead chart, so anything can look great on a dead chart. It's when it's live, that's the most important thing, is because how do you react in a live market? It's really what's important. So you have this high here, 163.49. So I'm going to go over my Trendy calculator. I'm going to give you the link where you can find it, and I'm going to scroll this up right here. And here I put the high in already, 163.49. What I'm doing with my Trendy calculator, now this is basically mathematical, like I explained in the first video, it's based off of a bell curve, okay? Is it perfect? No, nothing is, but it gives me an idea of where the marketplace could stop, should stop, potentially stop, reverse. I find it works really good with Fibonacci retracements as long as they're placed in the proper spot. So I want to go to my 618 retracement. Let's go back to the chart. My 618 retracement is at 158.30. So I'm going to go to my trend degree calculator, and I'm going to find a trend degree that's very, very close to 158.30. Sometimes it'll be really on the money. Sometimes it's not. It's going to be a little bit away, whatever, But I find a trend degree right here, 158.33. It's 39 degrees off of what this thing is calculating as what the mean of the bell curve is, okay? That means that it has potential to have support here. Now, if it breaks that, the next level is 157.15. Okay, and then if it breaks that, it's a 50 degree off of it. It's 156.76. So off of the top, we have all these levels, and we could use Fibonacci ratios if the marketplace is really moving strongly. But we have our first level, 158.33. The next level is 158.73. Okay, so let's go back to the chart. Marketplace comes down. Let's fatten it up a little bit. We can fatten it up here. Marketplace makes a low at 158.05. 158.33 was the trend degree. 158.73? Yeah, 158.73 was the degree above it. We have two things that we can do here. Obviously, buying at 158.40 with a stop at 158.05 works. Doesn't always work, okay? Nothing always works. But what I would do, how I would approach it was a break above 158.33. I'd look for a break of 158.73 as like a confirmation for me to get long. My stop loss would then be 158.05. Now we're talking about it's quite a distance, but my warning would be around that 158.33 level again. So let's see what the marketplace does. Marketplace moves higher. Okay, we would be getting long at like 158.80, something like that. 159 the figure. Okay, marketplace moves up, makes a high at 160.82, comes back down, retraces, and then takes off from there, goes a bit higher. Great. All right. What do we do with this? Like, okay, so if I'm a short-term trader and if I got long at 158, let's say I got long at 159 the figure, okay? We rallied up to 160, 160.86. That's a good profit, right? So what I would do is I would take the low, 158.10, I would go to my trend degree calculator and I put in my low, 158.10. And I'd start to look at what point we can get up to, whereas I could take profits. I got a point at 160.46. Now remember, the market went up to 160.80. So what I could do is once the marketplace goes to 160.80, I could place my stop at 160.46, my protective stop. Market gets hit. It goes back down again. Now, hang on a second. This whole wave is still good because the low hasn't been broken. The original analysis is still good. So again, a break of 151, right here we come down to the actual kind of trend degree, the original trend degree. We went to 158.37. So another break of 158.80 again, I could get long. Now it blows through this top. You know, if I was using the same type of principle, 160, say 40, where's 160.40? Doesn't touch it. It continues. Now we could start to use Fibonacci extension levels. Okay, so basically what I could do is, hang on a second. I never get this tool right because it for me it's completely backwards. But let's see something here. So I want an extension level. All right. So I want to reverse this. I could actually reverse this. Hang on a second here. Or I could measure this leg. You know, I can go up from this to this. You could either or works. Okay. I mean, it's one is 6 of this and a half 6 of this, half dozen of that. It's kind of very similar, but this is where it gets like kind of hokey. Not hokey if you understand that there's an internal leg measurement, which this is, and then there's the external leg measurement, right? So I could actually use this and extend up, or I could use this level and extend up. They're basically subjective to you. I mean, however you want to do it. But let's use what I would do is I would take this leg, okay? Hang on here, and let me get it right because I don't want to look like an idiot because I want my extensions up. So hang on. Okay, so what I did was I took this and I measured down to that low right there. Now I want my extensions up. I want above this price up, okay? Because why not, right? I mean, if I'm going for it, I might as well go for it, right? So I'm literally looking for 1.382. Here, it's up here. Came very close to it. There it is, it hits. But hang on a second now. So, wow, wonderful, right? So let's go back to the trend degree calculator. Okay, so I could find resistance points. I already have them here. So off of my low, 158.10, I got, now we got what, 164.44. Let's just look. $163.60. Hang on. $165.02. We have the target at 165.60. I got a trend degree at 164.42, 44. And what's the lower level? I probably would have got out there thinking that maybe we're not getting there, but let's see what the 164.82, 165.25. Let's go back to here. What's this level at? 165.56. So do I have a trend degree at 165.56 upper level? No. I got 166. It jumps to 166 after this. what's the high? 166.69. So it even surpassed that. So what I'm doing basically is I'm using my trend degrees in order, if I'm in and I'm breaking a top, I haven't broke the top yet, but if I was in a good trade and I'm holding, okay, I know the trend degrees give me the protective stop level. They're also giving me projections to get out with Fibonacci ratios. I mean, if I was looking for this level right here, the one, okay, the 163.50, it hits right here. Did I have a trend degree here? So if I go back to my trend degree calculator, I'm using this side, okay, 58 right here, hang on, 163.23, 164. So right now I could go right here, 163.29, and put my protective stop in 163. Where are we here? 163.62, 163.29. I would have been out, stopped out, or protective stopped out. So these are some of the tools that I developed to help me, and these actually help me determine like what's going on in the marketplace. What's the next step of the marketplace? So when I do my daily analysis, I talk about volatility, and I talk so much of my volatility sheets. I'm combining trend degrees with other tools that I have to try to figure out what the market's going to do, where it should stop at. A lot of times I nail it right to the pit. A lot of times I'm a little bit off, but a lot of times I'm completely off. But I wouldn't say a lot of times. I'd say 80% of the time I'm kind of spot on. Great. Doesn't really equate always to profit, but it helps. It helps protect me. It helps protect my profits. So anyway, I hope you like this video. Please, if you like what you say, if I'm trying to get you guys to look at things quite differently, because a lot of the information that's out there is not going to help you at all, and I'm trying to help. So if you have any questions for me, support at parkavenuetrading.com. I'll be happy to answer. Go over to my website, get my free ebook on breakouts, and leave some comments for me. And I look forward to seeing you in the next video. Cheers.